This is Matthew Cratter from Trader University, and today I want to talk about an amazing admission from the Fed. And I'm calling this "The Fed Just Spilled the Beans." In order to understand the context for this, we have to sort of rewind and review what's called the Fed's dual mandate. And this has long been considered what the Federal Reserve, which is the central bank in the U.S., what it exists to do. This dual mandate is maximize employment, keep inflation under control. These are the two main pillars of Fed policy. But as we've noticed in the past 25, 30 years, the Fed seems to have developed a new mandate, though they've never really made it super explicit. And this is the mandate of keeping the stock market happy. This really all began back with our friend Alan Greenspan and what's called the Greenspan put. This was basically, the analogy was like a put, which protects you from a stock going down, a put option. But the Greenspan put was really almost like a theoretical put option on the entire stock market. If the stock market goes down too much, according to the Greenspan put, the Fed, especially under Greenspan and then subsequent leaders, will cut interest rates and pump things back up. This really was tried first in 1987 after the stock market crash. Greenspan cut rates very drastically, and it worked quite well. And so then Greenspan began to apply the put to every situation. It's very nice when you're a leader to have things only go well. And so he wanted to make sure that the stock market had a very good run while he was the chairman of the Federal Reserve. And Wall Street began to figure this out. And together, Greenspan and Wall Street really created one of the biggest stock market bubbles in history from 1995 to 2000. It peaked in March of 2000. And when the bubble popped, when the overall S&P 500 bubble and the dot-com bubble popped, really the tech stock bubble, Greenspan cut rates very drastically and created a housing bubble to help to bail out the economy. Now, a lot of people, when I say this is a conspiracy theory, etc., but it's actually not. This was a very conscious policy decision that was influenced by Paul Krugman at the New York Times and Paul McCulley at PIMCO. And the actual quote from this New York Times article, it's an editorial by Paul Krugman entitled "W's Double Dip," referring to George W. Bush, of course. The quote in there was, "Alan Greenspan needs to create a housing bubble to replace the NASDAQ bubble." So for all of you who think that the housing bubble just came out of nowhere, this was actually a very engineered bubble, engineered by the elites. If you're finding this video helpful so far, be sure to hit that subscribe and like button and share it with a few friends. So Greenspan went from a stock market bubble to a housing market bubble. He's raised rates and popped that bubble, and in the process created the great financial crisis in 2008 to 2009, made a lot of people like Michael Burry very rich who were shorting housing using various derivatives. But the problem this time was each time the bubble got a little bit bigger. And this, as a result of the housing bubble and its popping, the entire U.S. banking system became insolvent. And this is really where we were in late 2008, early 2009. The entire U.S. banking system was bankrupt, no pun intended, and had to be bailed out. Fortunately, not a single banker probably went without a bonus, but this is who the central bank is, of course, really working for. And this was really early 2009 was when the money printing began in earnest. It's called quantitative easing, or QE. This also was the exact same point in time when Satoshi released Bitcoin on the world. So it's a great irony that these two things began roughly the same time, at least in the U.S. The Fed bought U.S. Treasuries, bought mortgage-backed securities, MBSs, from the banks to provide liquidity and really to reboot the entire U.S. banking system. As a result, the last decade has now seen what a lot of people call the everything bubble, where everything has gone up: stocks, housing, crypto, everything. And this is really how central bankers operate, especially in the last 25 years. They've created a series of rolling bubbles. And in the process, they've destroyed the purchasing power of the US dollar. This is the Fed's balance sheet. We can see where it was before the great financial crisis in early 2008. We were below $1 trillion on the balance sheet. Then they began to expand the balance sheet in the early teens, in the early 2010s. And they actually tried to shrink the balance sheet in 2018 and 2019. But that led to a mini bear market in stocks, a major bear market in Bitcoin and other crypto. And by late 2019, the Fed was forced by the repo crisis, which we've talked about many times, to start growing its balance sheet again. And then its balance sheet really exploded in early 2020 as the pandemic began to hit the market. So we did have what's called QT, or quantitative tightening, in 2018 and 2019, where the Fed's balance sheet actually shrunk as interest rates were also being raised. And then the Fed was forced to expand the balance sheet again. And this is really the bluff that the markets continue to call. Every time the Fed tries to tighten, things crash and get pretty dicey, and the Fed is forced to reverse course. What's happened, of course, in the last 12 months is that there's been a lot of inflation. This is really this increase in the money supply, which is basically the Fed printing money and using it to buy assets and then grow its balance sheet in this way. That increase in the money supply has really caused a lot of inflation. You see a lot of headlines like this now from the Washington Post. Democrats worry Biden could pay the political price for rising inflation. So there's a lot of political pressure on the Fed to do something about it once these inflationary pressures hit the grocery stores, hit the cost of food, and hit the cost of fuel or gas. And I've talked a little bit more about this in my January 6th Wire Stocks and Bitcoin Plunging video, where I go over some of this same history. But the important thing and the conclusion of that video was the Fed is going to tighten. We're going to have higher interest rates. The Fed is going to reduce these asset purchases, and it might even shrink its balance sheet. Reducing asset purchases is what's called tapering. Shrinking the balance sheet is when they actually either sell securities off their balance sheet or just allow them to mature and roll off, and in that way sort of organically shrink their balance sheet. But the hypothesis, my hypothesis, which I discussed in this January 6th video, was that the Fed will continue to tighten until something really blows up. Either the stock market falls too much, which is the kind of the classic Greenspan put, meaning the stock market can't fall too much, or the Fed bails everyone out. And also the 10-year Treasury yield, the interest rate in the 10-year Treasury note, was something else we're going to be watching in case it spikes too much. Now, we have seen, especially in the new year, we've seen yields move up sharply all across the curve. This is a chart of the 10-year Treasury. And we were really midweek, a couple of days ago, we were flirting with new highs here. And you can see the amount of pressure on the stock market from that. And so where the Fed really cries uncle is where you have yields spike, especially in the 10-year note, as well as the stock market sell-off. So the QQQs haven't really sold off that much, but they have been down. They really peaked in late November and have been down from there. So these are two of the main metrics you might want to watch if you want to learn when the Fed is going to reverse course. But where the Fed really spilled the beans is documented in this January 12th article, and I was really surprised to see this. This was a quote from Loretta Mester, who is the president of the Federal Reserve Bank of Cleveland. You have all these different Federal Reserve banks that report up to the big central bank and report up to Jerome Powell. And she was quoted is a very interesting quote from her. I guess it was in some live stream on Twitter. Mester, and this is a quote from this Bloomberg article, Mester said that the central bank should shrink its balance sheet as fast as it can without disrupting financial markets, and reiterated her support for a March interest rate increase. Here's Mester's quote: "The economy is in a much stronger place than it was when we started doing the reductions last time." What she's referring to is this shrinking of the balance sheet that we just discussed in 2018 and up until late 2019. And she's quite aware, and she's making us know that she's quite aware that was what caused all these financial disruptions. So she said the economy is in a better place now. I don't think it is, where the economy is actually much more levered. But she's saying this during this Wall Street Journal Live event streamed on Twitter. And then here's the second part of her quote: Frankly, I would like to reduce it as fast as we can, that is, shrink the Fed's balance sheet, conditional on it not being disruptive to the functioning of the financial markets. And this is really where the Fed reveals its third mandate, not just its dual mandate of controlling inflation and maximizing employment, but also protecting the stock market and protecting the functioning of the financial markets. And this is really confirms what I was saying, that the Fed will continue to tighten until they break something. And this makes it very clear in a way that I've never seen before. Mester makes it very clear that the Fed is monitoring this functioning of the financial markets quite closely. I would say, what's the only thing worse than inflation? If you're a central banker, of course, we have true civil unrest, and things could get very bad in the current financial system. But apart from that, the only thing really worse than inflation, if you're a central banker, is a dysfunction of the financial markets. Stocks crashing simply because, as we've said before in previous videos, this hurts tax receipts, which then means that the U.S. government needs to borrow even more money, which means that the Fed needs to buy even more government debt. The other thing that scares central bankers, as we said, are Treasury yields spiking spiking simply because the Fed's not buying enough Treasuries anymore. What this does when Treasury yields spike all across the curve, all across the yield curve, it increases government borrowing costs and risks blowing up our highly levered economy. And where the Fed just spilled the beans, Mester just made this clear in a way that I've never seen a Fed official do in such a transparent way, saying, I'd like to shrink the balance sheet as quickly as possible, conditional on it not being disruptive to the functioning of the financial markets. Now, what we've seen is the Fed hasn't even begun to shrink its balance sheet. It's still growing its balance sheet, albeit at a slower rate. And this has caused already quite a bit of disruption, as you've noticed in crypto land and with Bitcoin and with stocks as well. And so it's really hard to imagine that they'll ever get to the point where they're able to shrink the balance sheet. I think the market will call them out before that happens. I think the Fed, as I've said, will continue to tighten until something breaks. And Mester makes this very clear that this is what they are watching as well. I think this probably happens sometime in Q2, the second quarter of 2022. Maybe it happens a little bit sooner, but I think that's probably very likely when things will break. We often get quite a bit of selling going into tax day as well. I think there are a lot of crypto people who don't realize how much they might owe in taxes, and we might, as well as in stocks as well. So we might see selling as people try to raise money to pay their tax bills in April, at least in the U.S. Either way, whether it's Fed monetary policy or just the timing of the tax calendar, the Fed will keep tightening until something breaks. And then when something breaks, it's going to be forced to rev up the money printers again. And it might do this under the cover of a resurgence of the virus or some other exogenous threat. But you will know that the real reason is because they are looking out for the financial markets. There is still this sort of Greenspan put. Money printers will need to be on high for most of this decade. This is why Bitcoin and stocks or stonks and real estate are going to the moon. They will keep going up, not because they're going to be especially strong, but because the US dollar system is failing and everything denominated in dollars is going up because the dollar is weakening. Bitcoin will also gain purchasing power just through adoption. It will outpace this devaluation of the US dollar. But we can expect things to continue to go up. So I would say remain patient, hodl through the next couple months, volatility as the Fed sort of experiments here and sees what it can do without blowing things up. But I would say it's not looking very good for the Fed. And it's important to remember that the Fed is actually in a much worse position than any Bitcoiner because they can't simultaneously get rid of inflation and maximize employment and keep asset prices high. Something has to break, and it's almost certainly going to be on the inflation side. And just remember that it's the Fed, it's Wall Street, it's the existing financial system. These are the dinosaurs that are in the process of being demonetized by Bitcoin, by this magic internet money, which is like the meteor that hits the earth and destroys all of these financial dinosaurs. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.